Greetings. This is Tony Pizzello. I'm in my office at Northwest University. The course is BUSM 5573, Financial Management. And this is some information about week 5. I wanted to start off with some information related to the essay. Part of the essay says, describe an investment strategy that guarantees that you will not lose money to the informed traders and explain why it works. This is pointing you to the efficient market portfolio. If you hold the market portfolio and either buy on margin, which would be borrowing, or purchase treasury securities, a proxy for the risk-free investment, which would be considered lending, based on your personal risk aversion. So you do all that based on your personal risk aversion. This would guarantee that you, over the long haul, would not lose money to the informed traders. This is a practical result of the efficient markets. And so that should help you. Obviously, go ahead and give it your own personal twist on that as well. Then the second part was the dart throwing, buying and selling 5 stocks a day. Again, this is tied to market efficiency and the random walk. The idea is that over the long haul, there is no solid evidence that would support that highly skilled traders who are better informed than you are can outperform you. So throwing darts is as effective as any other random stock picking method. Over time, these random stock picking methods would underperform the buy and hold strategy of investing in the market portfolio. And so with the highly skilled traders who are better informed than you are. In other words, they cannot outperform you. There's no evidence that they can outperform you, no matter how highly skilled they are. And so you're going to do just as well by holding the market portfolio over the long haul and adjusting it based on your personal risk aversion, whether to borrow or borrow or lend. And then the last part, it says, would your answer to part A change if all traders in the market were equally well informed and were equally skilled? No, not really. I mean, the best you can do is to hold the market portfolio and adjust it relative to your risk aversion, whether you're going to borrow or lend, and hold the market portfolio. Okay, so that's on the essay. I want to go through a couple problems real quick related to My Finance Lab. I want to look at Chapter 12, Question 10. You need to estimate the equity cost of capital for XYZ Corporation. You have the following data available regarding past returns. Now, again, your numbers may be slightly different. This one shows the risk-free return 3% in 07, 1% in 08. Market return in 07 is 6, and the market return in 08 is negative 37. And the XYZ return is 10% in 07, negative 45 in 08. What was, first question, what was XYZ's average historical return? Well, that's pretty simple. You just add the two returns and divide by 2. So let me go to that over here. That'd be 10% and a negative 45 and divide by 2. So the average historical return, negative 17.5. And again, your numbers may be different, or probably will be different based on what the problem gives you. Okay, let's look at B. Compute the markets and XYZ's excess returns for each year. Estimate XYZ's beta. So for the excess returns, basically we have the market 3%, negative 38 for XYZ, and then we have 7% and negative 46. The beta, you'll see there is 1.29 using the formula in your textbook. Okay, estimate XYZ's historical alpha, excuse me. So the alpha is the intercept, and so I plug this in to the formula, and I get 3.1%, and I show you the math there on how to calculate the alpha. D says, suppose the current risk-free rate is 3% and you expect the market's return to be 8. Use the CAPM to estimate an expected return for XYZ stock. This is a very fundamental problem, and it's really quite simple using the capital asset pricing model. The expected return in this case is 3% plus 1.29, which is the expected beta, times the risk premium, 8% minus 3%, and so that comes out to 9.45%. And then finally, on this problem, on part E, would you base your estimate of XYZ's equity cost of capital on your answer in part A or in part D? And then it says, how does your answer to part C affect your estimate? Explain. So use D. The CAPM is more reliable than the average past returns, which would imply a negative cost of capital in this case. Ignore C, as alpha is not persistent. There's not, again, historical evidence to support alpha. All right. Also wanted to briefly show you Chapter 13, Question 29. You work for Microsoft and you are considering whether to develop a new software product. The risk of the investment is the same as the risk of the company. And rather than go through this step by step, I just want to show you the numbers that I got as I worked this problem. The risk premium on a monthly basis was about 0.50%. The risk premium on an annual basis came out to be about 5.97%. The risk-free rate was 3%. And then the cost of capital comes out to 8.97, and the CAPM cost of capital is 9.55. Again, each of these was calculated using the formulas in the book. By all means, when you are working on these problems, I suggest again that you go to, let me see, I need to back this up. Where was I? Right here. And when you go to the problems, what you want to do is click on this question help button right up here, and then it says view an example. And that's really the best way to get help on these problems, because it will take you through an exact example of what the problem is asking for. Okay? Have a great week, and once again, as it says online, the discussion is due on April 7th, and the rest of the work is due on April 8th. April 7th actually is Saturday, April 8th is Sunday, and so those are the dates you want to go by. Have a great week.